Have you ever wondered if you're leaving money on the table when you file your taxes? Specifically, if you're in a relationship, be it married or common law, have you questioned whether filing your taxes jointly or individually is the best strategy for your financial well-being? It's a question that many Canadians ponder each tax season, and for good reason. The way you approach your tax filing as a couple can significantly impact your overall tax bill, your eligibility for certain benefits, and ultimately, how much money stays in your pocket. Now, before we dive deep into the nuances of filing jointly or individually, let's clarify something that often causes confusion, especially for those familiar with tax systems in other countries. In Canada, married and common law couples do not file a single, combined tax return like they do in the United States with married filing jointly. Instead, every individual in Canada files their own separate tax return. This is a fundamental difference. However, even though you file individually, your marital status and your partner's income are still incredibly important. The Canada Revenue Agency, or CRA, takes your household situation into account when determining your eligibility for a range of credits, benefits, and deductions. So, while you're not filing one joint return, you are effectively filing as a unit in terms of how many of these tax advantages are calculated and optimized. This is where Wealthsimple Tax comes in as a powerful tool. It's designed to simplify this often complex process, especially for couples. When you link your profiles in Wealthsimple Tax, the software works behind the scenes to optimize your combined tax situation, making sure you're taking advantage of every possible credit and deduction available to your household. It's not about merging your returns, but about strategically allocating certain benefits between your two individual returns to achieve the best possible outcome for you as a couple. So, while the term filing jointly in the Canadian context refers more to coordinating your individual returns for maximum benefit rather than submitting one single document, the core question remains: how do you ensure you're making the most of your tax situation as a couple? That's what we're going to explore today, with some invaluable tips from Wealthsimple. Let's break down the key considerations and strategies. Understanding your marital status for tax purposes. First things first, accurately reporting your marital status to the CRA is crucial. Whether you're married or in a common law partnership, this information dictates how certain benefits and credits are calculated. A common law partnership, for tax purposes, generally means you've been living together in a conjugal relationship for at least 12 continuous months, or you have a child together by birth or adoption. If your marital status changes, it's essential to update the CRA promptly, as it can affect your eligibility for benefits like the Gulf Standard Time/Hawaii Standard Time credit and the Canada Child Benefit. Failing to report a change in marital status accurately can lead to penalties or having to repay benefits you weren't entitled to. So, even though you're filing individually, your relationship status is a critical piece of information that needs to be communicated. The power of linking profiles in Wealthsimple Tax. This is where Wealthsimple Tax truly shines for couples. As mentioned, while you file individually, Wealthsimple Tax allows you to link your partner's profile within your account. This isn't just a convenience, it's a strategic move. When your profiles are linked, the Wealthsimple Tax Optimizer can perform thousands of calculations to determine the most advantageous way to claim various credits and deductions across both your returns. Think of it this way: instead of each of you trying to figure out individually who should claim what, and potentially missing out on optimizations, Wealthsimple Tax does the heavy lifting for you. It automatically allocates certain transferable credits and deductions to the spouse who will benefit the most, effectively maximizing your combined refund or minimizing your combined tax owing. For instance, if one spouse has a lower income and doesn't need all of their non-refundable tax credits to reduce their own tax liability to zero, Wealthsimple Tax will identify if those unused credits can be transferred to the higher income spouse. This can include amounts like the spousal amount, age amount, disability amount, or even tuition and education amounts. The software's goal is to ensure that no available tax breaks are left on the table for your household. Key tax benefits and strategies for couples in Canada. Now, let's get into the specific benefits and strategies that couples can leverage, often optimized by Wealthsimple Tax. Transferable tax credits. This is perhaps one of the biggest advantages for couples, especially those with a significant income disparity. If one spouse has a lower income and doesn't fully utilize certain non-refundable tax credits, the unused portion can often be transferred to the higher income spouse. Examples include spousal amount. If one spouse's income is below the basic personal amount, the higher earning spouse may be able to claim a credit for the difference. Age amount. For seniors, if one spouse doesn't need their full age amount, it can be transferred. Disability amount. Similar to the above, unused disability amounts can be transferred. Tuition, education, and textbook amounts. Up to $5,000 of unused tuition, education, and textbook amounts can be transferred from one spouse to another, or from a dependent child to a parent/spouse. Wealthsimple Tax automatically identifies and optimizes these transfers when your profiles are linked. Combining medical expenses. Medical expenses are a classic example of where combining claims can lead to a greater benefit. You can claim medical expenses that exceed 3% of your net income or a certain threshold, whichever is less. If you combine both spouses' medical expenses and claim them on the return of the spouse with the lower net income, you are more likely to surpass that 3% threshold, resulting in a larger tax credit. Wealthsimple Tax simplifies this by allowing you to input all medical expenses, and it will then determine the optimal way to claim them. Charitable donations. Similar to medical expenses, charitable donations can be pooled by a couple and claimed on one person's return. The tax credit for donations increases for amounts over $200. By combining your donations, you can reach that higher credit threshold more easily, leading to a greater overall tax saving for the household. With that said, thanks for watching, and until next time.